Welcome to the Dallas Fed. We always say, and I'll say this again at the end, the Fed is very much a partnership between the public sector and the private sector in the community. And the insight we get on the economy, our entire process is very heavily dependent on surveys, advice, insight from the private sector. So the reason we do events like this is to get to know you, open up the Fed, but I would just want to say thank you for being here, and we can't do what we do without your advice and your input, so we're thrilled that you're here. You just heard a great introduction from Nitin. I've been friends with Nitin for a very long time. I was at Goldman Sachs, and in 2005, I went to visit the school, and the dean had me meet with Nitin, and at the end of a brief meeting, and I had never met Nitin before, and at the end of a brief meeting, Nitin asked, why don't you come teach here? Why, take a leave of absence. And, I run the leadership group, and you could be in my group. And I thought, boy, these academics, they really, they make decisions. They don't fool around. I realized after coming there, it didn't move quite that fast, but it was a great example. It stuck with me, and I wound up and came back, and we taught together for years, and we've become great friends. And it's one of the reasons I stayed at Harvard for 10 years is basically to work together with Nitin. And so it's been a thrill. I'll mention one other person. There are a lot of great people in this room, but I want to particularly, I'll embarrass him, I want to particularly identify Richard Fisher, who most of you know, who has been head of the Dallas Fed for years, was an incredible head of this institution. He's waving me off here, but I can't help it because a lot of what we do here and what we build here at the Dallas Fed is due to the great people of the Fed, but it's due to Richard's leadership. So Richard, thank you for being here, and it's always great to see you. All right, so with that introduction, I'm going to jump right in. And this is the Globalization Institute. So we're going to talk about what you're seeing going on in the world. And I guess the first thing I want to ask you is, as you look at the world today, what's the biggest issue you see, or what's the biggest concern you have about what you see going on in the world?
So first, I'm truly delighted to be here as well. Mark, thanks for the introduction. And Rob, thank you so much for having me here. And Richard, it's great to know that the Dallas Fed is essentially a province of Harvard Business School people. I'm very grateful for that. So I'm thrilled that we have Harvard Business School people at this institution. So I think that right now the big question is, if you think about what happened in the last 25 years, I mean, the last 25 years has been an extraordinary period of global growth. And that has benefited certainly people in other parts of the world, but it has also benefited tremendously U.S. companies. If you just look at the U.S. economy and how much incremental revenues and profits have come from global growth, it's really quite extraordinary. The S&P 500, more than 50% of revenues, now almost 50% of profits. So the slowdown in global growth is, to my mind, perhaps the biggest question that is of global concern, because, take the country that I grew up in, which is India. 200 million people were brought into the middle class in the last 20 years in India, after 100 years in which we had only been able to do that for 15 million. So it's been so you say, but there's still 600 million waiting, saying, when is my turn? And now all of a sudden the prospects of their entering the middle class look a little bit more dim. And you can repeat that story in so many different parts of the world. And that's, of course, bad for growth in these markets. But in the end, I also think that it's bad for America, because our own growth and the opportunities for our own companies come from many of these markets as well. So this, to me, is the big question right now, which is China slowed down, India still is growing, but not growing that much. Brazil is looking like 5 years of negative growth rates. Yeah. So, there used to be this enormous excitement about the BRIC nations, and all of a sudden that excitement has become very tepid. So you have to really say, where is global growth going to come from? And that is both important for the prosperity of the world, but I think is equally important for the prosperity of our country.
So since you've been dean, and on this point, you've initiated a very large-scale project on competitiveness. Mm-hmm. First, U.S. competitiveness, but I think it was intended by application to talk about competitiveness generally. As it relates to this growth slowdown, what are some of the lessons that the U.S. competitiveness or the competitiveness project has highlighted that you think the world is not paying enough attention to? What are some of the things that need to be done here and around the world?
So I think that, we've clearly seen that one of the things that makes nations competitive is the fundamentals. So you have to make sure that you have a high quality of education. You have to improve the skill level to participate in the global economy. Because in a global economy, if there is a job that can be done by someone else who's equally skilled at a lower level, at a lower cost somewhere else, and the transportation cost isn't that high, which is increasingly true for information goods in particular, that job will get competed away in a global economy. So every nation has to think hard about how to think about the skill level of its people to invest in what feel like long-term investments but are essential investments for the competitiveness of those nations. And we learned that about the US, which is to say that while we have a very strong economy, if you look at the fundamentals of our economy, particularly K through 12 education, we're lucky still to have the greatest higher education system on the planet. But that system is being challenged because other universities and other places around the world are now beginning to invest in higher education. It seems to me that in general, the US is running the risk, as many other countries in the world are, that we seem to be very quick to take on long-dated liabilities, but very slow to invest in long-dated assets. Right? And long-dated assets are things like R&D, things like our education system, where if you invest today, or infrastructure, the payoff isn't 1 year out or 2 years out. The payoff is 10 years out, 15 years out. But if we stop investing in those things, competitiveness will gradually erode, and I think that's the risk that we run right now.
Okay. So as dean at Harvard Business School, for a lot of people, it's a lot of people here come from the business world. I came from the business world, and I learned a lot, and you've explained to me a lot over the years about the difference between running a business and being dean of a college, or of a business school or president of a university. What are the biggest challenges you worry about in being dean of Harvard Business School?
So there are two things that I worry about as dean of Harvard Business School, and I say that in the context of a school that is entering its second century and is actually in many ways in about the strongest shape it's ever been. The one thing is that if you look at students who are now thinking about applying to Harvard Business School, so in the end you say, great universities are two-sided platforms. They're great because they can attract great students, and they can deliver to them a great education, and the way you deliver a great education is to have fabulous faculty members join Harvard Business School. So today, and we're not alone, it used to be the case that from 1950, which is what 1950 to 2000 was probably the golden age of business schools in the United States. It was triggered by the GI Bill and people coming back from the war. And we found that business schools were a great way to reintegrate people who were coming back from the war into the economy. It was a generalized education. Many of these people had leadership skills. If we could put them to work in the economy, that was great. So between 1950 and 2000, MBA education grew like gangbusters. And it was a fabulous way for a young person to say, if I join a business school, I'll get a great return of investment in the short run. I'll get ahead in my career. I'll get a better job than I would have gotten otherwise. I think in the last 15 years, the short-term value proposition of a business education has become more questionable. If you look at simple things like salaries that students get when they exit versus salaries that they used to get before they joined, that gap has become smaller over time. Companies themselves have started to be anxious that if they let their people go, even your own firm, Goldman Sachs, it used to be one of the best places in terms of people coming to Harvard Business School. Now they have programs where they say to people, you don't have to go to business school. You can continue to progress and become even partner at our firm without having gone to business school. So this ends up being a great challenge for us. How do we continue to persuade people about the long-run value of a business education? Because I still think that a business education is an extraordinary long-term investment for people. It's worth remembering that no business sector or no company has a half-life that's more than 20, 30 years, whereas our students will have careers that will be 45, 50 years long. So preparing yourself for a career in which you can exercise leadership in a wide variety of ways, including look at what you're doing today, I think that a business education is a remarkable thing to do that. But in the short term, it's harder for people to make the case to come to a business education. I think that's the biggest challenge that we have right now, that some of the very best and brightest who 10 years ago would have automatically thought of getting a business education are no longer as convinced that they should do that. and they're looking for reasons for us to come. In many cases, they're not going to business school at all in their 20s. And other business schools are responding by creating executive education programs, Wharton and others, to say, well, if you don't go in your 20s, you can go in your 30s.
So just staying with this, just to give people some statistics on a few items. How many applications a year and how many people get admitted?
So we have 10,000 applications a year, and we make 1,000 offers, and we're very fortunate that about 90% of the people whom we offer a place to come, so we have very, very high yield. So, it's a kind of 1 in 10 chance of getting in, and as Dee Leopold, who used to be until recently our head of admissions, says that GMATs and working in good companies and having reasonable grades are essentially table stakes for being in the pool. If just based on that alone, we would probably admit 6 people for every person that we admit today in terms of people who were statistically the same on all of these dimensions. So what we're looking for is really a leadership spark. What makes this person special? Have they caught the eye of a professor or someone whom they work with, and have they shown what we believe will be the kind of leader who will make a difference in the world? Have they already started to do that, or are they waiting in some ways for the rest of life to catch up with
And
them?
is the 10,000 all-time high, or has it come down a little bit?
So we have actually, as a business school, been going up about 2 or 3% a year.
So even though this concern about people not applying, it hasn't affected Harvard Business School.
Yeah, but it is. But if you go below the top 10 business schools right now, and you look at 10 to 50, applications to full-time 2-year MBA programs has been declining by about 10, 15% in the last decade.
So let's give a sense, demographic background, gender, parts of the world. What's the breakdown of the class?
So 40% of our class is now women. It's worth remembering that in 2013, we celebrated 50 years of women being admitted for the first time. So 1963 is when women were first admitted to Harvard Business School as regular members of our class. They used to be admitted in some other categories before then. So from that, we've gone to 40% right now. About 35% of the class is international students. They come from 70, 80 different countries. What's striking, though, is that even the American students who are on our campus now have a very global experience, because undergraduate institutions have gotten better at having study abroad and a wide variety of things. So you start to see a classroom where I think people have clearly begun to realize that the future lies in this global economy that we were talking about.
The percentage of the cases that are U.S. versus non-U.S., I know you track all this.
Yeah, so we teach about 500 cases over the 2 years at Harvard Business School. And we write 250 new cases every year. So in the last 5 years, more than 50% of the cases that we write are now global cases. So it could be American companies operating in markets abroad, or global companies that we think represent the competitive challenge for these companies, and we need to better understand them. So it's really striking that the curriculum at Harvard Business School has now deeply become a global curriculum. So about 40% of the cases that you would encounter out of the 500, if you came to Harvard Business School, would be cases that were global cases, because we really deeply believe that the next generation of business leaders cannot be educated to be leaders if they don't understand what's going on in the global economy, even if they run a purely American company, which most of them will.
And where are they going in the world? What percentage are staying in the United States versus going to work outside the U.S.? Do you have a sense of that?
So 85 to 90% of our students will still work in the United States.
Even if they're not from the U.S.?
Even if they're not from the U.S.
Yeah.
We wish we could staple green cards to the students that do graduate.
Which is one of the proposals of the U.S. Competitiveness Project.
Yeah, which is really sad when you look at the fact that we have made, as a result of now very difficult immigration, even for the highest skilled people. These are people who we have invested in. We've given them scholarships. We've invested in their education at Harvard Business School. It's people like me who came to MIT and graduated in '88 and managed to stay here. Now we're making it very hard for these people to get jobs in this country.
Yeah.
So you might have people sometimes stay for the first 2 years, which is when you can still get a different kind of work visa. You can get practical training visas. In some cases, after that, when you have to convert to a green card, there are people at that point who are leaving our country. And if people are leaving by choice and want to go to other markets and build companies who in the future will become our trading partners or will become our friends, I'm all for that, right? So it's not like we just need to keep people here. Leadership is needed in business in every part of the world, and having other people build strong businesses in other parts of the world is not to our detriment. It's to our advantage to actually have strong companies in other parts of the world that we can do business with, who understand us because they spend some time at Harvard Business School, who have relationships with us whether it's just Harvard Business School or any other business school. I use Harvard Business School as a proxy for what you might think of with other business schools. But I don't think that this is something that we should take lightly, the fact that we've made it so hard, even for the highest skilled talent in our country, to now continue to work in the United States.
Last question. Industries that the students are going to, including nonprofit industry, how has that changed over the years, the trends there?
So, people often think of Harvard Business School and they say that there's a lot of people who in their first job go into finance and consulting. That remains true. So half of our class will graduate and about a quarter will go into finance, and or more, about 30% will go into finance, and 25% or 20% will go into consulting. What has risen immensely is tech. 5% of our students will now join nonprofits. Many of our students will join the healthcare sector. In fact, there's several people here from Tenet, which is one of the companies here, so I'm delighted that they're here. And that's a highly fast-growing part of our students, because our students tend to follow where there's growth in the U.S. economy. So if you think about tech and healthcare being growing parts of the U.S. economy, you see more students enter those arenas. Of course, what's striking is that most people think about, they're so obsessed about what people do when they first graduate from Harvard Business School. And I always remind people, but, that's just the first year in a 40-year career. You should be more interested in what our students are doing 20 years later or 25 years later. And here's the startling statistic. 50% of our students will be a principal or founder of their own company by their 25th year graduating from Harvard Business School. We recently did an impact study, which is we just tried to assess all the people who go out and become owners and build new companies. So Harvard Business School graduates have founded about 50,000 companies that are currently active around the world. $2.9 trillion of revenue on those companies. They employ 10 million people. So this image that you have of business school students being people who just go off and end up in a very narrow sector of the economy couldn't be farther from the truth. That may be true in the short run, but if you look at how our students' careers evolve in the long run, it's actually quite a remarkable story of the engine that these schools can create. And we're not alone. This is true of Stanford GSB and Columbia and others, that students may graduate into a narrow thing, but after they build their capabilities, in the end, they want to be owners and they want to try and run companies.
And what have you learned about their involvement in the community, people who go to the school, what they're doing in public service, nonprofit?
So that's another, I think that we're living in a period, and if you ask me, one of the other challenges that we have today, and I think of very deeply as Dean of Harvard Business School, is the extent to which business people have become suspect in society and are not viewed as people that are interested in the common good, that they seem to be often viewed as people who care about themselves and don't care about society. I mean, nothing could be farther from the truth. I mean, the first and foremost thing is that business itself is, to my mind, one of the greatest engines for creating social prosperity. It's the most sustainable way of creating social prosperity, because there's only so much that you can do with charity or with government support to keep people having what they need in a sustainable basis over time. But business people are stunningly philanthropic. 80% of our alumni are engaged in some philanthropic activity. Even by their 10th year, 2/3 of our alumni will serve on the board of a nonprofit, even by their 10th year. So this is not something that now people are waiting to say, it used to be the case that people said, I'm going to learn, earn, and then return. We find more and more that our students are saying, no, there's no reason to postpone returning in various ways to society. They're passionate. They're engaged in many, many of these activities. And so whether it's, just some interesting statistics, if you took a list of the top 50 hospitals in the country, the top 50 public universities, the top 50 arts organizations, almost any form of civic organization that you think is important to our life, we have Harvard Business School graduates and business school graduates in general massively overrepresented.
And how many in Texas?
How many?
I know you know the number.
We have a little over 4,000 alumni in Texas. How many here? How many Harvard Business School grads?
Wow.
See, there you go. Not a bad
You just
throw.
can't get
Thank
away
you very
from
much. We can't get it. It's great. Thank you all for coming.
You wrote, speaking of the public good and business being held in mixed esteem, put it lightly, because my former industry, financial industry has sort of been a big part of that. You wrote an op-ed a few weeks ago about the importance of Wall Street. I don't know how many of you saw it. and basically comparing Wall Street here, or the financial industry here versus, say, India, and how critical it is. Why'd you write that op-ed, and what were you thinking in terms of what were you trying to emphasize?
We were getting ready to graduate another class of students at Harvard Business School, and I had this conversation with a student who said, you know, I'm joining finance, and I have to explain myself to my friends and even my family members about why am I choosing to do this. It somehow cut at me that we would have people who are joining this sector who somehow feel that they have to explain what they're doing to others. And
just before you go, how many of you are in the financial services in some way here? Okay, all right, keep going.
This is the Dallas Fed. So it's a little biased sample.
That could be.
I would argue, but you know, I had grown up in India and had so many occasions in life where my family personally had encountered challenges because of an underdeveloped financial system in which it was very hard for people to get capital. For those of you who read the article, I talk about a moment in my own family where my father, who was a very successful business person in India, and in this country would have easily found a way to be an entrepreneur, whether he was successful or not, but he would have at least got the capital to be an entrepreneur, had gone out to try and raise capital, and because he had no collateral, could never get it. It was only after India liberalized in 1992 that my family could even afford to buy its own home, because you had to buy a home by coming up with all of the capital up front, as opposed to being able to get a mortgage system. So there are so many functions that finance provides that are essential. I mean, I think of finance as being, in many ways, just like the human body has a circulatory system, finance is the circulatory system of an economy. And yes, you can always have problems in any sector, and finance is not immune from those problems. You can do predatory lending, but you know, you could also, as a doctor, over-medicate people. So it's not like there is anything that is very powerful in life always has risk of doing great good, but also doing great harm if you're not careful with how you use it. And I just wanted to say that finance is no different. And we should be very careful that this is one of the great strengths of the American system. So if you were to ask yourself the question comparatively across countries, who has a financial system, you know, where can you have better allocation of risk? Where can venture capital or people who want to start businesses have greater opportunities to start businesses? Where can people who want to buy a home buy a home? Where can people get an education if they want to get an education? So if you ask yourself, what is the depth to which these fundamental ways in which human beings can improve their lives, which only a financial system can provide? Part of what I think is the challenge is that we've never done a comparative analysis. We've never said, what is it that so we rate every country on the planet on their educational performance. So we say, like how well do people do in math and science, and we say, well, we are disappointed because America ranks 30th. How do we feel about our country when it comes to the financial system? I think we would rank very, very high in the world on almost any measure of what our financial system is able to deliver on a wide variety of metrics. And it's probably useful for us to remind ourselves of that, because living in a world in which the public, because I think the government in the end does respond to the public. If the public doesn't have confidence that what business people do, and in particular what banks do, is valuable to them, then we will live in the world in which regulation will increase, and that's not good for any of us.
So how did the business leaders screw this up? Given it's a vital industry, seriously, you and I have talked a lot about this, so we've had lots of discussions over the years. The industry is a high-performing industry. It did a lot of things well, but somehow something went wrong. What went wrong? What happened, you think?
So I think that as much as we want to applaud things because they're good, we collectively have sometimes taken less responsibility when things don't go well. I remember when the financial crisis occurs, people said, it's all your graduates who destroyed the financial system because you send so many people into finance. And we had a few examples, very public examples. And I said, yeah, so when people do things that are not good, we shouldn't feel proud of them. Just like we should applaud the people who do good things, we should not be embarrassed to say that when people don't do good things, that's not a good thing. And so I think we have a collective responsibility, one, to make sure that when things happen in the system that we ourselves believe are not good, that we should speak up. We should not act as if those were just some 3 sigma deviation, bad apples, like one bad apple and the whole the whole barrel is good. I mean, the reality is that there were parts of the barrel that had gotten really quite corroded, and we need to attend to that ourselves.
Has it changed the way Harvard Business School teaches? The lessons from what happened, has it changed our approach?
So, for example, like in the, we now will relentlessly try and find any example of a Harvard Business School graduate who has, for whatever sort of reasons, ended up engaging in a moral failure or has done something that hasn't worked quite well. We'll try and write a case about that because we want our students to have an opportunity to early on recognize that as good as they are, they're fallible, and if they end up engaging in things that constitute moral failure, that's a bad thing for them personally. But it's an even worse thing for business as a whole, because business as a whole suffers. People will hold us much more to account for all our failures than all our successes. Now you might say, why is that? Well, that's what any person who has privilege inevitably suffers from, right? Like you get a lot of benefits out of being privileged. So remember, if you abuse that privilege, then people will hold you to account and then hold you much more to account than on just the good side of the ledger. So that's one thing. I think the second thing that we have to be careful about is that we complain about regulation and we complain about how complicated regulation has become. But one of the things that we learned in the U.S. Competitiveness Project is that take the U.S. tax code. Everybody can, in principle, agree that we would all be better off by a simplified tax code until it becomes their particular tax provision. So you say, so we all agree that it's a simplified tax code, but if I'm in this industry, of course I want to keep mine, and if you're in the other industry, you want to keep yours. And so for a period of time, the last 30 or 40 years, we have now a very complicated regulation system that didn't just come from government. It came because we lobbied and we found various ways to have our little favorite piece of regulation into the system. And now we've created this complicated, almost Rube Goldberg type of system that everyone says, oh my God, one of the things that's dragging down US competitiveness is not that we have regulation. I mean, we can all agree that some level of regulation that is sensible is actually vital for the conduct of any economy. The problem is that we have too much of it, and it's too complicated, and it's too onerous, and most people can't even understand. I joined the board of Mass General Hospital, and every day I sit there and I say, God knows what regulation is going to come get us. I mean, it's like one of those really complicated things that, and nobody knows. It's become just way too complicated. But I think that we should be careful that we shouldn't just say that this is just the fault of the government. We have, in some ways, personally, as business people, been responsible for creating the complexity that we live with today.
So you've studied leadership, you've written a lot about leadership, you've taught it for decades, as you and I both know, and you are a leader. If you had to say one or two pieces of advice, most important piece of advice you'd give to leaders in the audience, either in their business or in nonprofit sector, what would a couple of suggestions be?
It's, in some ways, one thing I've learned about leadership is that it's very hard to say anything that doesn't sound like, that great Chauncey Gardner movie or something like that. You remember that movie? Where anything that you say is, it sounds like something hokey and that is commonsensical wisdom. The problem with leadership is that a lot of it is commonsensical wisdom. You just have to practice it. So I have learned that especially the more senior you become as a leader, the more people care about what you do and the less they care about what you say. It's almost like, and we all train leaders to say lots of nice-sounding things, but the reality is whatever you say, people will watch very carefully for what decisions you make, who you promote, who you reward, who hangs out with you, all of the things that, and if you reward someone who just delivers a number but doesn't live by the values, then people will say, yeah, I know what the values of this company really are. The values of this company are by hook or by crook, you make some money. And if you say that, I'm all for R&D investment, but every time there's an R&D investment proposal and what you say is, well, that's not going to make money in the next 2 years, so why don't we cut that proposal, or why don't we wait for that proposal for the next 2 or 3 years? It's these everyday actions that leaders take that matter, in my view, a lot more than the big vision statements that people come out and feel is the act of leadership. Yes, people want a vision, people want a sense of direction, but what really changes the legitimacy of leaders day by day is the everyday actions that they undertake, and do people believe that those actions reflect the strategy or the vision or the big priorities of the leader.
So biggest warning sign, as you watch leaders, biggest mistake or warning sign you see, when you see it, you think, well, this person's heading for trouble?
So I always say to people that If you don't hear something every week that makes you just a little bit uncomfortable, which is someone says something to you that says, now why did they say that? It pinches a little bit. It actually pinches. When you stop hearing that, you're in real trouble as a leader. You better hear something every week, and that's my tell sign. So if someone doesn't say to you something every week, that just makes you say, like they challenge something. They say it's not going as well as you thought it was going. Because nothing's ever going as well as you think it's going. I mean, that's just the nature of a large, complicated organization or a startup or anything. And I think leaders who insulate themselves from hearing the real news often get themselves into real trouble, because as smart as you are, you're never as smart as any 5 people in a room, and certainly never as smart as the whole organization that you might run. So I think that's the single greatest difficulty that I see with leaders who start to believe in what they're doing so much that they stop learning from the rest of the organization.
Why do you think they do that, by the way? Because everybody agrees they shouldn't do it, but they do it anyhow. Why does that happen?
It's just easier, because sometimes when you hear the stuff that you don't want to hear, you don't know what to do about it. So you just say, And I say that not as a joke. I actually mean that seriously.
Yeah.
Right? I mean, the challenge is that if you listen to everything, you feel some obligation to doing something about it. Now, you can't actually do something about everything that you hear. So if you hear bad news, you actually have to have some capacity to prioritize which one of those things you need to do something about. How do you act on it? And it can come relentlessly, right? It's not like there's a small amount that comes at you. So I think it's easier. It's a tough enough job. You feel beleaguered. It's hard enough to drive the things that you're driving on a daily basis yourself. So it's tempting for you to say, well, let's not talk about that right now, because don't you see this program that you and I are both excited about that we should be getting going on? And people pick up on that. And they say, well, maybe the right thing to do is to only talk about the things that the leader is interested in pursuing. And these other things, even if they're important, we'll just set them to the side.
All right, let's take some questions from the audience, and we'll come back and I'll ask you a few more. But let's go ahead and turn to the group. Yeah, please. Harvey.
Hi, Harvey Rosenblum, a professor of finance at SMU these days. After listening to your remarks at saying you're going to distinguish leaders not by what they say, but what they do, and I'm going to run the risk of never being invited back into this institution again. As we observed the Federal Open Market Committee over the last several years, there's been a lot of talk and very little action. The ratio is somewhat lopsided.
I don't think you're alone in thinking that.
I want to use that as an entree to one of your opening remarks about the accumulation of long-term liabilities and very little in the way of short-term assets.
Well, long-term assets. I mean,
lower returns on MBA programs. Again, nobody wants to take on the liabilities because the assets may be questionable. But I'm wondering about the distorted set of incentives that we have come across in our society these days, in our economy. It's global, it's U.S. Where are these incentives driving the key business decisions? We'll get away from that FOMC thing that I started out with. I just wanted to make a speech. But I just wanted to kind of get you to focus on the long-term incentives that young people face, that our business leaders face, and where does the Federal Reserve fit into this incentive-setting system? Because the Fed does set a few interest rates in the economy, or at least drive the direction of them.
So I think that in some ways you have a bias to the way you asked your question, and I share your bias, which is that we are creating very few incentives for people to think long-term right now. And this is all the way from the Fed down to any company, right? So if, essentially at zero interest rates, I mean, you can attach any value that you want to anything. And so you can start to, buying assets always looks cheaper right now than investing in R&D. So you see this happening throughout companies. You see it's a great time to, since you don't know what you might invest in, you engage in buyback of stocks. So there's a series of ways in which what you find is that if you look at the total investment right now in capital expenditure, that is long-term capital expenditures in companies, they're at close to an all-time low. So I think that your instinct that we have created a world in which all of the opportunities seem to be short-term. Nobody even has enough of an ability because of the way we've lived. I mean, everybody in some way suspects that the world that we currently inhabit, which is close to zero interest rates, nothing growth, at some point will change, right? So we keep hoping at some point this will change. You don't know when that some point is. So in the so in the meantime, what do? You play for the short term because that's the only imaginable environment that you know something about. The uncertainty about even the medium-term world is so high that for anybody to make a bet on something that's medium-term seems like a crazy bet to make. So you make the bet which feels more certain, which is I know that in the short run, interest rates are likely to remain close to zero, and so that's the way the game goes. And so I think we have the same issue today in human capital and how people think about, like, take MBAs, So I know today that if I stay at Goldman Sachs, I'll get a good salary and I'll remain successfully employed over the next 5 years because the firm wants me and is desperate to keep me. If I leave and go to Harvard Business School, I take on more uncertainty. Maybe my life will look better 20 years later when the dean tells me that all of us will become owners and that's what I really want to do. But why take that chance? Why not just stay where I am today, or if I stay at Google, or if I stay at one of these other firms? So I think that we are seeing this short-termism, at least in my mind, everywhere, because people are more assured of the world that we have created for them to live in the short run, and much less clear about what happens in the medium to long term.
So I might throw something just for fun. We're just here talking, so I'll throw something out. Strikes me there's 3 or 4 trends going on. And because the Fed has been the only game in town, some of it gets attributed to the Fed and some. So one of the things I've noticed, if you look at asset allocation in the world, it's actually never been more illiquid. People are making more long-term bets. In fact, I think many endowments and foundations have gone too far. And they're much more illiquid because they're searching for return. They're actually less short-term oriented, ironically.
But they're liquid in what kinds of assets?
Alternatives.
Yeah.
But they're making longer-term investments. That's why timber is so popular and other things. Now, on the other hand...
So real assets, I agree with you.
Yeah, so on the other hand, why is CapEx then so low? And most CEOs I talked to, and I covered companies for 30 years, it's lack of anticipated demand. Yeah. They really would, but they can't keep cash on their balance sheet, so the default is buy back stock. But the third thing, which is really, I think, we're struggling with, is the level of disruption, which you might has never been higher. It's going like this, and there's not a business or a person we talk to who's not saying, well, gee, I think I want to do this, or I think I'd like to invest in my business, but the model is being disrupted. And so that's also having an effect on people. What are you seeing, particularly on that third? Some of the things we're attributing to rates, which I happen to agree with. I actually agree with you and Harvey and what you both said. But I think some of it is the level of disruption, and we tend to be maybe mixing all these things together.
I agree with you. It's probably useful to try and separate out the various reasons why people may have more anxiety about things that are medium to long term. And I certainly think that technology and the disruption that technology might be able to, take. I'm on the board of Tata Sons, so full disclosure. One of the companies that we own is Land Rover Jaguar.
Right.
Okay, so you sit on a board and you say that, here's a person who comes to you and says we want to make a big investment in an engine plant. And you have to ask yourself the question, even as someone who said, well, we as companies should be making long-term bets in these things. You say, what will be the overall global capacity that is needed in the automotive industry 10 years from now if this vision of autonomous cars becomes real? I don't know.
Yeah, I don't
know.
Right?
I don't know either. But if you're a betting person, you can't say that there's, the range that people talk about is that we may need 20% as many cars as we have. That's one side of the world, which people say, look, the automobile is the single worst asset utilization product on the planet. Right? 8% of an automobile is actually used on an ongoing basis. So you think about this huge investment in this particular asset. And you say, does autonomous cars make that asset utilization go up to 40%? Like, will most of us not own cars, and we basically have cars come and pick us up and take us to wherever we need to go to? Uber has already done a little bit of that. Right, just to take our own family, right. We used to own 3 cars, we own 1. Because now we live in the city and there's no particular reason for us to have 3 cars. If that turns out to be true, then I, sitting on the board of Tata Sons, has a very hard time saying to this company, why don't you make a bet on something that will only pay off 10 years from now? right? Because that's what it takes for you to make an investment in an engine plant. You can't make an investment in an engine plant unless you have a belief that 10 years from now there's going to be demand for these cars that's increasing. And I think that this question is arising in more and more places that I know, which is people say, I don't know what this disruption might mean for my company, for my sector, for my economy. And so let me be a little cautious about making these investments whose payoff period will be longer if I'm not sure that that's what it's going to be all about.
Yes, sir.
Good afternoon. Jim Falk from the World Affairs Council, and we're here at the Globalization Institute, and there's been a great deal of discussion about the various free trade agreements, which in a sense creates disruptions and winners and losers. So I wanted to hear your thoughts about what is the role of government or the role of corporations and leaders in creating new jobs for some of the losers.
So I think the challenge that we face is that we're clearly living in an economy where the reality of the experience of even previously middle-class people is that globalization has created an increasing threat to my job. So let's at least say that if you talk to people like that, that's the felt experience that they have, and we cannot deny that felt experience because it's real. So then the question ends up being, how can we respond to that? So one response is to say, let's try and shut down globalization. I'm not sure that that response ends up actually being a very productive response. So you might say that that's a response. The other response is to say that, we have to figure out a way to create an economy in which reskilling and improve skilling in our education system. It's a longer-term response, which doesn't help you, so you might create tariff barriers and you might say, okay, I can protect my steel industry for another 3 years or 4 years by doing that, or 5 years for doing that. But we've seen countries that have tried to do that in the past. It's a very short-term fix that in the end produces even more misery than the gain that it had. Take the UK steel industry right now. It's an industry that's dying, and the government can try and protect it for all at once, but it's an industry that does not deserve to exist and will not exist 5 years from now. Irrespective of what the government does right now to kind of try and prevent quote-unquote Chinese dumping of steel. I mean, the reality is that China has more capacity to produce steel than all of the rest of the producing nations combined, and you can try and deny that capacity, and they will retire some of that capacity. But if the capacity is available, you can't deny that that capacity exists. So I think that we are all looking to more short-term measures rather than asking the question, how do we create an economy in which we have no choice but to improve the skill and productivity of our workers? An advanced nation cannot remain an advanced nation unless the skill and productivity of its workers continues to rise faster than that of other nations. That is the real challenge that our country has to confront. And we could enable this transition a little bit by slowing down some things, by being a little bit more protectionistic in some ways. But let's be very clear, at best we might just buy ourselves a little bit more runway. But if we aren't doing the work on the other side, even the runway that we bought will be worse, because then there'll be an even more spectacular crash. So we use this extra runway to not do these things and start to fool ourselves into thinking that we've actually fixed our economy, which I worry we might do. Then I actually worry that the crash that lies on the other side is much worse.
Yes, sir.
Hi, Professor. I'm Sanjeev Khanna from U.S. India Chamber of Commerce. Can you comment a little bit on the ever-increasing U.S. debt, how it would look 10 years from now, 20 years from now, ever since increasing the deficit along the way as well? Like with the interest rates, it may be a little bit more manageable, but there will be a time when interest rates will be high.
So I'm in a room in which I'm in the Fed, and this is a topic that I'm like a leadership professor. I know nothing about macroeconomics in particular. So, there are 2 points of view about this, and you can actually make a credible argument on both sides. So there's the Larry Summers camp that says, and we are over-anxious about the debt. What we should really be concerned about is to try and get the GDP of America to grow, that if America were to grow at 4% and could return to 4% growth, none of these debt things are something that we care about. That in terms of the debt service ratio for an economy that's growing at 4%, it would be very easy for America to take care of its debt obligations if we could be convinced that America could grow again. So that's sort of one argument. And then there are other people who say, no, there's a good conservative sense in which you all feel like, you should always only spend what you can earn and you should never do more. And there's something deeply human about this belief that indebtedness is something that you should manage at some level. I think that both arguments have some merit. It's always bad to be more indebted than you could be, and if debt is being used for frivolous purposes and is being used to do things that we really don't need to do, then I think that to that level debt should be constrained. And we saw that with household spending in the United States, that when people were spending in ways on credit cards and others that they really didn't need to spend on, the economic crisis turned out to be a good moment to remind people that having some measure of self-discipline about how you spend and the indebtedness you take on as a family is a good thing. But I don't think that I personally come out on the side where I don't think that debt unto itself is a bad thing. I do believe that we need to continue to rely on the fact that the U.S. economy, we all hope right now that it will at least grow 2%. To me, even that number is a fragile number. I don't think we should be as confident given the volatility that lies everywhere else in the world. I think we're quite interdependent with other parts of the world, so I'm not so sure that even that number is one that, today we think of that as a floor, right? We all think that at least 2% we will grow, and maybe we'll grow faster than that. For this economy, we should still have an aspiration, and I think that's the big question that we should ask ourselves. How do we get the U.S. economy to grow 3% or more? And then these concerns and anxieties about the debt, I think, would be less severe than they are today.
So if I told you, just to add on to this, that which we've talked before, demographics in the U.S. and all advanced economies
That's the big issue right now.
Are going the other way, where potential GDP likely 5 years from now will be lower than potential GDP today. So instead of debating 2% 5 years from now, we'll be debating 1.75%. Assuming there's not a burst in productivity or capital spending, how should we deal with that?
I think that in some ways, that's the single biggest issue that we have that doesn't get as much attention as it should, which is the changing demographics of our country, right? So every day, I think you might know the number better than I do. How many people are retiring every day or hitting the age of 65 every day now?
I don't know the exact number. We know the participation rate in 2007 was 66%, and today it's down to 62.6%. Yeah, and 10 years from now, it'll be below 61%.
And so as this baby boomer generation, which we're just beginning to see the front end of, continues to, in some ways, drop out of the workforce, we're going to see one of the most productive generations of Americans, well-educated, educated through the GI Bill and others at a time in which they got very highly skilled, but we still had jobs in this country that were good middle-class jobs. These people are all going to be dropping out of the labor force, and they have some savings. The savings have not done as well in recent times as they would have done otherwise. So they're going to be net withdrawing things out of the system. So you say, who's replacing it? What's the fast-growing part of growing in the economy? So we're going to have an increasingly large Latino population in this country that's growing. It's the fastest growing demographic in our country. And if you ask yourself, how well educated, how well are we doing by that population in terms of are we creating the right skills? Are we getting that, the people who are entering our workforce, are they more skilled people than the ones who are leaving our workforce? I don't think we can be confident of that at all. In fact, that is going the other way. Right. That the growing part of our economy is going to have lower skill than the retiring part of our economy. That is not a recipe for growth, which is why I say that in some ways, for America to withdraw from the global trading system and to not take advantage of the fact that there are many, many other places in the world where there are still young people who will join the economy and will be consumers. And we, if we are more productive, with fewer people can provide those people with the goods and services that they need. That has to be a part of our story. And we have to, in the meantime, make sure that we don't have a lost generation of people who are going to enter our workforce and be stuck in non-paying jobs or become liabilities of the state. These are very real challenges, in my judgment, and you and I have talked about that. And I think that this is a set of issues that we really need to think about very, very hard.
So that's a dumb question, and then we'll go back to, why aren't we hearing more public discussion of these? Or maybe we're hearing plenty of public discussion, I'm just watching the wrong, reading the wrong papers. Are we hearing enough public discussion? Are we facing reality here? And if not, what do you make of that?
I don't know. I think that this is maybe the same issue that we talked about in terms of long-term versus short-term. It feels to me that it's, when you're anxious, sometimes it's even easier to simply talk about the things that you can do in the short term. Right? So it becomes easier to talk about, should we have trade or not? Should we shut down immigration or not? Should we have more government programs. I'm not trying to be partisan
Should we
in
raise
any way.
the Fed funds rate?
Yeah, there's all these things that and even in whichever side of the political aisle you're on, I think that we end up with recipes that feel more and more short-term, and people who want to hear things that seem to be able to address. And I'm not saying that that's wrong. I mean, they have anxiety today, and they're not going to. They're saying, what does the next 5 years look for me and my family? They're not asking the question, what does the next 20 years look for America? And you can understand that, right? Like if I'm an individual, I care about what is going to happen to my family in the next 5 years. And the idea of what's going to happen to America in the next 20 years feels a little bit more abstract.
Let's take other questions. Yes, Martin.
So Martin Sturmer, I work in the research department here at the Federal Reserve Bank of Dallas. I have one question. Why has new business formation slowed down, and despite these very low interest rates? And do you see the slowdown in entrepreneurial activity also in your graduates?
So we certainly don't see it slowing down in our graduates. If anything, actually, we're seeing an increase in the rate at which our graduates at all stages in their life are taking on entrepreneurial opportunities. So the one thing that, again, we've got so used to this Silicon Valley idea of people dropping out to start their businesses. The reality is that people open businesses at all stages of their life. In fact, we've done research on our alumni base, and the median age at which someone will open a business is 40 years of age. In fact, Bill was just sharing this data. He has kept it on his desk as an example of someone who started a business after he'd had a great career at BCG and decided at some point that he wanted to build a business. He's not atypical. Actually, that turns out to be the median case among our alumni. So we are, if anything, now seeing the rate at which people will do that increase across all parts of our demographic spectrum. But the aggregate data, as you say, for the country is exactly what you said, that we're seeing a slowdown in business formation. A lot of people tell me that is in part because the small business engine, which has been very often the engine where you think about new business starts as opposed to the Silicon Valley engine, which I think is continuing to do well, relies upon credit formation and regional banks and small local community banks being able to deliver a certain kind of credit and certain kind of capital for these companies. And I was talking to someone just in the reception here today, and they were saying, look, the combination of regulation and low interest rates makes that lending environment much more complicated than it used to be. So my great worry is that have we created circumstances in which it's just harder for the community banks and the regional banks, which is really where the small business formation occurs, to lend into that system.
Let's take any other questions in the audience. Yes.
I'm Mahesh Shetty. I'm the chairman of the U.S. India Chamber of Commerce. My question to Mr. Nohria is specifically on leadership. So as we think about a society and we think of the emergence of Mr. Trump, did we as a society fail to detect the angst amongst people where they are voting en masse or at least supporting him? What did we miss as political or business leaders to see the emergence of somebody like that?
So again, to try and make sure that we are being bipartisan, I think that people on the Democratic side were as surprised by the rise of Bernie Sanders as people on the Republican side have been surprised by the rise. So the continued popularity of Bernie Sanders was as troubling to, or as surprising for the political pundits on the left as the rise of Donald Trump was on the conservative side. I think in each case they're tapping into what I just described, which is this anxiety that families have, that they say, I'm not sure that I know how to make my life feel better in the next 5 years. And I'm hopeful that the government will be a big part of helping me in some way, shape, or form. So there's a different sense in which people feel that the government should be helpful to them on both sides of that political spectrum. But there is really a sense in which people feel like the government needs to intervene to help my life get better in the next 5 years. And both Bernie and Donald Trump, I think, are in various ways tapping into that anxiety and finding a way to deliver a message. In each case, I think their ideas seem to me to be very hard to implement, but at least they're tapping into a message that resonates with that group of people who feel, I don't know how my future looks better, and I hope the government will help me out.
So this feeds into a trend we've talked a lot about: wealth inequality, growing income disparity. I've also heard you made the point, ironically, while we have more wealth inequality in the United States and income disparity, globally, it's the opposite.
Period, yeah.
It's actually closing the growth.
And there's many ways of thinking about inequality. The most obvious way in which we think about inequality is how much of the wealth is captured by the very top percent relative to others. And in that sense, probably inequality has grown everywhere in the world. But globally, if you ask yourself the question, how many people were lifted from abject poverty to actually have middle-class lives? We have done more in the 15 years of the 21st century to lift people out of poverty into middle-class incomes than we did in the entire 20th century. It's a remarkable period of actually lifting people out of poverty. Now you can say, for those who are already middle class, the fact that their lives have stagnated or have become worse, it's no comfort to them that so many other people have joined the middle class. And I understand that, so I'm not saying that we should not be mindful of the fact that for those who were already middle class, the fact that they have seen none of their lives improve, and this is one of the big results out of our US competitiveness project, is that middle class in America has stagnated and started stagnating in 1975, roughly, and has actually been mostly stagnant. I mean, there's been modest growth, but largely I think the experience of those people in life is their life has stagnated for a long, long period of time. So we have to worry a little bit about that tension. So I think the real challenge that we have is the following. I came to this country because in part what I liked about America was that it was a country that was not anxious about inequality. People said that, if your neighbor had a larger home, then that was something to aspire to. If your neighbor had a larger car, that was something that if you did better and you worked harder in life, you could aspire to. It was great to come to this country and say, if I worked hard and I went to MIT and I studied and I joined Harvard Business School, I don't know that, if someone had told me that one day I would be dean of Harvard Business School, that was like a fantasy beyond a fantasy. It would not have, but at least I knew that if I worked hard, I might get promoted to associate professor. That I did feel was an attainable goal. But it's a remarkable thing to actually even know that, because in India, had I been a professor, I would not have even been sure that being promoted to associate professor was an attainable goal, because even that could have gotten politicized or one of those things. Right. So I think that what people now worry about in America is that proposition, which is if I work hard and I do all of the right things, will I get ahead? People have begun to question that idea. I think that's a very deep thing for us to be troubled about. And the sense of inequality about that is great. So I learned a statistic from someone in our education school, which just blew me away. If you are born in the lowest quartile of people in this country, you will enter primary school, which is when you join kindergarten, having heard 20 million words less than someone who was born in the top quartile. Yeah. Okay? It is almost impossible
to catch up.
For someone to catch up if that's the deficit that they've been dealt. The other thing that we think about is, we keep thinking about school, and this person says that the average person in the lowest quartile of this country will have 1/10 the number of enrichment opportunities that a person in the top quartile will have, an order of magnitude difference. So these are summer camps, art classes, this, that, and the others. So the people who are rich can provide all these opportunities for enrichment for their children. And it turns out that those enrichment opportunities are like school. They actually matter as much as going to school does. And we have no ability to provide those things to people. I think it is these kinds of hard realities of inequality, as opposed to just the income inequality, which we are so obsessed about. So my own view is that we should start talking about other forms of inequality beyond income inequality, because if we want a capitalist system, which I hope that we still believe in this country is something that's important to us, inequality is part of capitalism. Just to be clear, there is no capitalist system that can operate without producing some inequality of outcomes. But inequality of opportunity has never been a part of a capitalist system. In fact, what has made a democracy and a capitalist system traditionally great is that we believe that it creates equality of opportunity, even if it might create inequality of outcomes. I think we've gotten so obsessed right now about inequality of outcomes that we have forgotten that the real thing that we should be obsessed about is how do we level and address the inequality of opportunity that now seems to have become very systemic, very structural, and very ingrained in our economy.
All right. I'm going to ask you one final question, which may relate to all this about facing reality and listening to bad news. And one of the things I know you've been a leader of in the last 10 years at Harvard Business School with our students, executives, and MBAs is dealing with their emotions, the emotional blocks that keep us from maybe dealing with problems as leaders. Can you just say a few words about that? Final question. Just what are you doing new at Harvard Business School, and maybe some things people in the audience could think about that you wouldn't normally think of being taught at a business school, but might be very central to their ability to develop as leaders?
So Rob has been very much a partner in all of this work, so you could answer the question as well as I, but in fact some of your books came out of doing this same work, which is, especially your book,
But I like hearing
Look
you
Yourself
talk
in the Mirror,
about
but I'm saying, so my feeling is that many people are surprised by the fact that what they rationally understand, they don't do. But it is repeatedly the case. Look at me, I know I should be 20 pounds lighter, but, I know that rationally, but that doesn't mean that, when I saw that wonderful cheesecake that was sitting at this table that I didn't end up eating it. Now, that turns out to be true about everything. It turns out to be true about leadership habits. It turns out to be true about everything. So we've started to create a course at Harvard Business School called Authentic Leadership Development, in which we encourage our students. So when usually at Harvard Business School, we teach by the case method. You come to a class, 90 students, and it's showtime, right? So you've got to find a way in the 2 minutes of airtime that you get to impress everybody in your class. So a lot of what ends up happening in that context is that people present leadership, which I do think is leadership is a lot about showtime. You do have to stand up and present yourself and make a compelling case. So we think that this practice of giving people an opportunity to influence a business conversation is a very deeply important thing. But it means that you haven't had the time to really retreat and ask yourself the question, how do I really come across? How do people think about me? What are my real values? So in Authentic Leadership Development, we've created a class in which people can meet in groups of 6. They sign a confidential contract with their colleagues, and they're supposed to have authentic conversations about what are their fears, what are their aspirations, how might their life stories have influenced who they've become. And it takes a little bit of time, but when students actually have that conversation, I'm blown away by that fact that about 2/3 of the students in that class will report, this is the first time I had an authentic conversation with anybody. And if I'm being honest, it's the first time that I may have had an authentic conversation with myself. Because successful people especially end up living in a world in which it's very easy to live the world by proving that you're successful by passing the next hurdle. So I will tell mommy and daddy that I'm successful because I graduated from Harvard Business School and I got a great job. But is that the job that I really wanted? Is that really what I want to do? How do I come across to my colleagues? Is this the life that I want to live? So having this capacity to have a conversation with yourself and an emotionally laden conversation with others, I think is a capacity that business people tend to have very little of, or they're not at least trained to have. And we're trying at Harvard Business School to find ways to get people to have at least some of that conversation in their own life. So those of you who are a part of the YPO, the young YPO, they've created these forum groups, and you've seen that there's value in this kind of conversation being had in a wide variety of ways, and we're trying to learn and try and do that at the school as well.
Nitin, thank you for your leadership. Thanks for all you do. Thanks for coming here to the Dallas Fed. And we look forward to doing this in the future again. But most importantly, I think you play an important role in the world in trying to help people face reality, become better leaders, and develop people that can help address the problems of the world. So thank you for all you do. And I've got a little memento from the Dallas Fed.
Thank you, Rob.